South Africa moves to place crypto under capital flow controls. South Africa's national treasury has published draft rules that would bring crypto assets inside the country's capital flow control regime, according to a Cointelegraph report dated April 24, 2026. The proposal would treat crypto transfers out of South Africa as a regulated capital movement rather than an unclassified digital transfer, closing a gap that residents and companies have used for years to move value across the border. Bitcoin traded at $78,266 as of April 24, 2026, broadly flat on the day, which suggests global markets have not priced the South African move as a systemic event. But for traders, exchanges, and payment firms operating inside the country, the draft is a significant change of frame. What the Treasury is actually proposing, the draft sits inside the Treasury's broader exchange control modernization work. Under current rules, South African residents face discretionary and single discretionary allowances that cap how much rand they can move abroad each year without special approval. Crypto has historically sat outside that perimeter because the South African Reserve Bank, SARB, classified it as neither currency nor a listed security. The new rules would change that classification for cross-border purposes. When a South African resident buys crypto on an offshore venue, or transfers crypto from a local exchange to a wallet outside the country, the transaction would count against the same capital allowance bucket as a fiat wire. The same goes for corporate treasuries moving stablecoins offshore for payments. The Treasury has framed the draft as an anti-arbitrage measure rather than a ban. Officials want the tax and exchange control system to see crypto the way it already sees other value leaving the country. Why this hits local exchanges first? Local platforms such as Luno, Valar, and Altcoin Trader sit directly in the flow of this rule. If the draft is adopted, these venues would have to report outbound crypto movements to SARB in the same way that banks report outbound wires. That means stricter KYC on the destination side of a withdrawal, attestations from users about their remaining annual allowance, and new transaction blocks for residents who have already used their cap. This is a cost increase, not a business model change. But it turns domestic exchanges into a reporting choke point, and it pushes some volume toward peer-to-peer venues and offshore accounts that users have spun up through intermediaries. Both of those paths are the specific behaviors the Treasury says it wants to curb. For SpendNode readers, the second-order effect is on spending from your own wallet. A resident topping up a self-custody card with stablecoins from a local exchange is, under these rules, potentially moving value out of the RAND system if the card settles offshore. The draft does not yet spell out how card issuers will sit inside the reporting chain. The broader pattern: South Africa is not the first emerging market to try this. Nigeria's central bank spent years restricting banks from touching crypto flows before eventually partially reversing. India uses a blunt tax instrument instead, with a 1% TDS on every crypto transfer. Turkey has banned crypto payments while leaving holding and trading alone. Each country has picked a different pressure point. What makes the South African approach distinctive is that it keeps crypto legal to own, trade, and spend domestically. It only changes the treatment of cross-border movement. That is a narrower intervention than a payments ban, but potentially more durable, because it plugs into an exchange control system that the country has run for decades. What to watch next? 3 things will determine how heavy this rule lands. The first is the threshold structure. If the Treasury treats every outbound crypto transfer as a capital movement regardless of size, small users will be hit hard. If the rule carries a de minimis floor, most retail activity will pass through untouched. The second is the stablecoin treatment. RAND-denominated stablecoin flows inside the country are arguably domestic. Dollar-denominated stablecoin flows to an offshore wallet look identical to an outbound wire. The draft will need to pick a lane. The third is enforcement. SARB has the authority to sanction banks that handle unauthorized outbound flows. Extending that to crypto exchanges requires either direct licensing or a bank-side choke point on fiat deposits and withdrawals. The latter is faster and more likely in the short term. Public comment on the draft will run through Treasury's standard consultation window. Final rules typically follow 6 to 9 months later in South Africa's regulatory cycle.